PV Tech Newscast. Here are the stories we'll be covering this week. Global solar installation in 2013 hit 37 gigawatts according to EPIA. The Philippines bounced back from Haiyan with over a gigawatt of approved PV pipeline. Chaori Solar become the first Chinese firm to default on a domestic bond. And we look at the state of play 1 year on from the EU's anti-dumping legislation. Global solar installations in 2013 hit 37 gigawatts according to the latest data from the European Photovoltaic Industry Association. The figures include 11.3 gigawatts for China, 6.9 gigawatts in Japan and 4.8 gigawatts in the US. There were mixed results in Europe. Germany fell from 7.6 gigawatts to 3.3 and France from 1.1 gigawatts to 613 megawatts. Several other countries made gains, however, with Greece, Italy, the UK and Romania all topping the 1 gigawatt mark. The EPIA figures are in line with Deutsche Bank's estimated numbers and are more positive than those of some other industry analysts. NPD Solarbuzz, for example, predicted 49 gigawatts of solar demand for this year, having predicted 36 gigawatts for 2013. The pipeline of approved PV projects in the Philippines reached over 1 gigawatt in January, according to the country's Department of Energy. As part of the Philippines' Renewable Energy Law, a movement by Congress to develop and utilize renewable energy, 59 on-grid projects totaling just over a gigawatt and 5 1.5 megawatt off-grid solar projects have now been approved. Still pending approval from the DOE are 9 solar projects with a total of 90 megawatts. PV provider SunPower is constructing a 350 megawatt manufacturing plant in the Philippines to be completed by the end of 2014. The Philippines has been proactive in encouraging the uptake of renewables in the country, especially following Typhoon Haiyan. In January, Senator Lauren Legarda called for developed countries to put their money where their mouth is and invest in clean technology, energy efficiency and natural disaster prevention, arguing that long-term investment was needed to avoid widespread loss of life due to climate change. Chinese PV manufacturer Chaori Solar has become China's first firm to default on a domestic bond after missing an interest repayment. Earlier this week, Shanghai Chaori Solar Energy Science and Technology warned it would be able to meet only a fraction of the 89 million yuan repayment, equivalent to $14.5 million on the 1 billion yuan bond issued in 2012. According to numerous media outlets, including the BBC and Reuters, the default has now been confirmed, with the BBC reporting that the company is planning to meet only 4 million yuan of the expected repayment. The rapid growth of Chinese PV companies was brought to a halt last year, when high-profile names including Suntech and LDK Solar defaulted on overseas bonds. With Chaori now joining this list, it seems likely further consolidation in the Chinese PV industry will happen, particularly with the Chinese government having already indicated that it wants to curb wider oversupply in the republic's PV manufacturing sector. In December, it excluded around 80% of the country's operating PV supply chain manufacturers from a list of 109 companies that would continue to receive domestic support measures. Chaori is one of the companies on this list, but its fate remains unclear. And finally, it's coming up to a year since Brussels and Beijing reached a compromised solution for the supply of PV components to Europe. With reporting from PV Tech blogger and Solarbuzz VP Finlay Colville, we'll take a look at how the situation panned out and whether anyone involved actually got what they wanted. Now, while both the capping of Chinese supply into Europe and the establishing of a floor pricing was achieved, it's far from clear whether European solar PV manufacturers now have the scope to sell at higher ASPs, allowing them to be competitive again and see higher margins by virtue of European perceived quality. Apart from a very small subset of solar PV module suppliers to Europe, mainly the premium brand suppliers, other module suppliers are having to price below the Chinese floor price in order to get any business. Now that's the total opposite of the original goal of all the lobbying and political settlements. Why? Well, one of the things that the EC failed to grasp was that money is king with those that finance solar PV projects. Only modules that are bankable and meet the due diligence processes of investors and insurance companies can be used for large projects. And here, the list is dominated by Chinese module suppliers that have global, multi-gigawatt supply potential and are deemed low risk with good quality. The harsh reality is that the Chinese market leaders feature prominently on almost all of these bankable lists in Europe. Politicians can't change these lists, and if that means buying Chinese modules at the floor price level, then so be it. But that leaves the rest to undercut the floor pricing in order to get business, often on small rooftops or in the residential markets. But the questions don't end there. When the EC did its in-house investigation process, a key consideration was to estimate manufacturing costs outside Europe. If ASPs are deemed to be less than estimated manufacturing costs, then a guilty verdict for dumping is fairly easy to justify. However, Chinese manufacturing costs are the lowest in the world, that's simply known, and European manufacturing costs must be higher, not least because they have smaller and often older capacity, higher labour costs, and often only cover one part of the value chain. So, if non-Chinese suppliers to the European market are having to sell below the Chinese floor pricing level, are these suppliers not dumping by an even greater margin than the EC concluded the Chinese suppliers were prior to the floor price coming into effect? For now, this remains the biggest unanswered question in the whole post-EU anti-dumping exercise. Will the EC decide to investigate non-Chinese suppliers selling below the Chinese floor pricing level? And how will these manufacturers justify these pricing levels when their manufacturing costs are blatantly well above the Chinese grouping? Fortunately for the EC, module pricing is somewhat flat in the global PV industry, so the floor price level probably doesn't need to be revised right now. The European market size is fairly static in terms of annual demand in 2014. So long as everyone is happy with the status quo on pricing deals, there's unlikely to be any appetite to introduce any new uncertainty, and policymakers may indeed take this as a stamp of approval on their original deliberations. However, ASPs aside, once the case runs its course, there will certainly be questions asked about what it has done in order to restore competitiveness for European PV manufacturers selling into their domestic markets, or whether it has unintentionally created the very pricing environment it was meant to avoid in the first place. Food for thought until next Tuesday's newscast, when we'll be bringing you exclusive interview footage with Suntec's new CEO, Eric Luo, and developments on China, the US, and a special report on Ukraine's energy future. Until then, you can keep up to date with all the very latest news via our website and our Twitter feed. See you next Tuesday, and thanks for watching.